before we start officially, just say hi to each other across each other. How about how? Everybody just say hi. Hi to everyone all around. Hi, 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 hi. We've introduced us. So if you have any question, if you see, oh wow, this guy look friendly, later I'm going to talk to him or her. Go ahead. Go ahead. Okay. So we want you guys to share your experiences, share, whatever that's happening right now from the schools, and talk to each other. I like this table because this table is very diversified. Yeah, we have NYP, we have SUSS, we have SMU, right? Yeah, so it's all over. This is the very cool table. Sometimes I call it rojak, but it's good, it's really good. All right, so you guys know what you're here for. Earlier on, we went around for interview. If for those who have joined us later, you might not have seen it, but we have went around to check what you guys here for. Knowledge, right? Most of you, political correct answer. Oh, you're here for the knowledge. Yeah, so it's all about gaining knowledge. But in this format, okay, we want you to gain by learning and sharing, not just one way. That is why you're all seated like that, right? So we also have facilitators. Some of you have met them. Yeah, we have Rashma, we have Andy, all seated around. We have Alif as well. So they will be in your group. Yeah, and of course later on we'll share with more of our facilitators' information. And of course, this is World Investor Week 2022. This is My Money 2022. It's a collaborative effort between MoneySense, the Association of Singapore, or Bank in Singapore, ABS, Singapore Exchange Limited, the Securities Investors Association of Singapore, and Institute for Financial Literacy. This initiative aims to raise financial literacy levels among consumers and empower responsibly. This event will be held in conjunction with the World Investor Week, which you can see here, 2022, which is a global campaign organized by the International Organization of Securities Commissions to raise awareness of the importance of investors, education, and protection. So importantly, as we go investing, what is the most important? What is the in thing right now? Scams, right? That is where you need to learn about how to protect yourself. Okay, and of course today, not just learning, we also want to share. A lot of you want to know one key thing about portfolio, how to start, right? These are all on our mind. Because as 20s, as I myself also poly, we're going to step up. My time, where do I get info about investment? I don't get it. Maybe I'm not so savvy about internet. That time, did I just divulge my age? Yeah. So long ago, we do not have so much sources. So right now we are bringing them to you. Yeah, so that's very important. So today, our topic, building an affordable, diversified investment portfolio. We have early in the morning, just right after this, we have our panel discussion on important investing consideration, as well as we have a dialogue session with Gravity Media in the afternoon. Okay, so again, we're allowed to stress on this is a networking session. Okay, so we want you guys to be very comfortable sitting down, and of course, later on, we have people coming to you to share and talk about how you can learn and start your journey with investing. All right? Can everybody, look at me stunned, why? Are you too handsome or too ugly? Everybody, give yourself a round of applause. Thank you for joining us this morning at the heart of Singapore, Burbs Kitchens and Bar. So, to start off the event, let's welcome a very handsome, he's like, a very handsome moderator, yeah? I really love him. Let's give a round of applause to Aaron!
Let me check if this is on. Yes. Okay. Good morning, everyone. Thanks for joining us. Thanks for taking the time. We know that a lot of you are not used to being awake on Saturday morning, so I appreciate that. My name is Edward. I'll be your moderator today, and I love to introduce you to the three amazing people that you'll get to speak with. They'll tell you a bit about themselves, but primarily we want to hear from you because we want to hear your questions, because this is a great opportunity, a once-in-a-lifetime opportunity for you to speak with three of the leading minds in finance in Singapore. Without further ado, I'm going to introduce them. First off, from UOB, he's the speaker from the Association of Banks in Singapore. Please give a big round of applause to welcome Mr. Francis Tan. Welcome, Francis. Have a seat. And next up, one of the best people to talk to about insurance anywhere in the world. He is the CEO of Provident Limited, and he's the speaker from the Financial Planning Association of Singapore. Please welcome Mr. Christopher Tan. And last but certainly not least, you've seen his ads everywhere because he's the co-founder and chief investment officer of Stashaway. Please welcome Mr. Freddie Lim. So I'm going to start by asking, so the format of this is that I'm going to start by asking these three gentlemen to tell you a bit about themselves. They'll tell you a bit about their experiences, their thoughts on how they started getting investing, doing business, some of the good things they've done, some of the mistakes that they've learned from so that they can save you some money along the way. And we'll give you lots of time to ask them questions, okay? So when that comes, just raise your hands, we'll get the mics to you. So let's start off with Francis, okay? Francis, you're working at UOB now. Tell us a bit about your background also. You're an economist, right?
Yes, that's right. Yeah, I am. So hi everyone, my name is Francis from UOB. Currently with UOB Private Bank as an investment strategist in the CIO office, Chief Investment Office. I started off like you, all of you seated here. I was from NUS. NUS, all right, okay. Thank you. So I was from the Arts and Social Sciences. When I was like you, sitting there, I'm not sure what I want to be in future, but I know that economics is my love, is my passion. Right? And then I went on to, I was in the civil service, in the public service for a while as well, as an economist. So later on, during the lunchtime, if you want to find out more about public service, I can also help a little bit, civil service as well. And then I was an entrepreneur for a short while, around 3 years, doing import-export, wholesale. So I wasn't really a full-time economist in my first half of my career. And then second half of my career, I became more into economics and the application of economics into strategy for clients. I have a couple of clients who have always been asking, Francis, you are an economist, you are a strategist, what is the difference? So I was telling them very simple. Think of it the following way. An economist, if you have been reading in the media, economist explains to you what is happening out there. For instance, interest rates are rising. The economist tells you why is it happening. Oh, because inflation very high. And the textbooks say, according to Taylor rule, we need to increase our interest rates. But he stops around there. The strategist will go on one step further and say, based on that, what should you do with your money? That's about it. Thanks, everyone.
Thanks very much, Francis. Yeah, please give him a big round of applause. Next up, we have the CEO of Provident. You might not have heard of Provident before, but it's a very special company. I've had a couple of friends actually work for you, Chris. So Chris, can you tell us a bit about yourself and what you do at your company?
Hi, everybody. Very good morning, and thank you so much for being here. My name is Chris. First of all, I'm, how should I put it? I'm a family man, so I've got 2 kids, and I was looking at all of you. All of you look like the same age as my children. So my son is 24 years old. He just graduated from university and is working.
You're a lucky guy.
And then my daughter is studying in the university. So I started out being a regular in the army. I didn't have the opportunity to go to a university like all of you. I went to the poly, did engineering. And then subsequently, I was a regular with the army as an army officer. But when I was in the army, I did a part-time degree in finance. Yeah, and then I went to pharmaceutical. But I've always been interested in finance. And back in the 90s, if you want to be in the wealth management industry, you either join the banks, you join the insurance company, or you join the stockbroking firm. I ended up with an insurance company, spent 3 years with the insurance company. Life was pretty good. I was doing pretty well. But at the end of the 3rd year, I was really unhappy to be with the insurance company because I wasn't doing any advice at all, but I was just selling a lot of products. Although it made me a lot of money, but I didn't have that job satisfaction. So subsequently, I came out and I started my own firm. That was in 2001. It's called Provident. It is Singapore's first fee-only wealth advisory firm. By fee-only, it means that when clients come to us to take advice, they pay us a fee for the advice. We don't take the commissions. If there is a reason for them to go into any product transactions, be it investments, be it insurance, we rebate the commissions 100% back to them. It is our way of making sure that we fulfill that duty of care to our clients, and any recommendations that are given to the clients, they are purely in their interest and not because the product pays us well. So right now, the company manages about 900 million of our clients' assets. I'll be looking forward to having a conversation with all of you. Thank you.
Thank you very much, Chris. Now, why this is important, actually, because Chris is here. He's mentioned something very important, the fact that his company doesn't work on commissions. It works on fees. And this is very important for you because many of you have never bought insurance for yourselves. You will be approached very soon by your friends who are joining the insurance industry, and they will ask you to buy. And you wouldn't know what they are, I promise you, okay, you wouldn't know what they're selling you. Okay, so this is a great opportunity to ask Chris, okay, what sort of insurance do I need? What do I need to look out for when I speak to my insurance agent? How do I know they're not trying to pull a fast one on me? Because I can tell you for a fact, my first insurance policy I bought when I was 23 from my ex-girlfriend's classmate, and I didn't know what I was buying. I'm still paying for it today.
Ex-girlfriend, you say, not wife?
Ex-girlfriend, for good reason. And last but not least, we have Mr. Freddie Lim. Freddie, you are the CIO of StashAway. You founded the company as well. But before that, you did a lot of different things also.
God, too much to say, but I got to be very careful with time. First of all, I'm amazed you are here. Friday night, all that drinking didn't happen, huh? And this morning looks like it might be raining, and you made it here, so congratulations. Yeah. Thank you for coming. Give yourself a clap. Okay?
Well done, everyone.
I'm old, so I'm going to be very quick. I'm a theoretical, I'm an econometrician back then. You call it data science now. And also I had this economics, half of it is an economic angle. Then I wonder, when during university, how can I get a job, right? And it was very difficult. My first job I wanted to do was to be in insurance, not as a salesman, as an actuarial scientist, looking at data, how to charge you premium as you aged, right? The population structure, demographics, and all that. So I'm into numbers, as you can tell, and I want to be in insurance. For some reason, everybody rejected me. I end up on the trading floor of Lehman Brothers, first in Chicago. So back then, there's not a lot of technology. Everybody used hand sign. We clear billions of dollars of trading on the floor. People wear specialist jackets. By the end of the day, everybody was dropping on the ground dead, just so dead beat, dead tired. Now, the trading floor of exchanges, they are just for tourists, where the real actions are in cyberspace. So you are a very, very different generation than when I first started. But that was exciting times to know how to negotiate on the phone about a price, how to see that the screen is fake, it's not exactly the real thing. Today, that skills is lost. But thank God I'm still a mathematician, I'm still a data scientist, I still have some use, and it culminated finally, all the itch of being in fintech for so long. I finally left banking without even caring about my bonus. It was a month before my bonus as a managing director of investment bank. I just said I had enough. I had enough. I got to do something about it. I don't know what I'm going to do. And I just left. So that was me in 2016, September. And because I made the effort, I bumped into like-minded co-founders. We never knew each other before, but it turns out it's 6 years now. We're like high school friends that never met. So what I'm going to say is, in life, you experience journeys, adventures. Just make sure you remember to build networks, to just make an effort to surround yourself with good people, people who challenges you, people who motivate you, gives you positive energy, and maybe something will happen. For me, it was StashAway. So the story is still not finished. We'll see how it goes. So it's my first entrepreneurship as an older person, been a professional mostly. So I'm enjoying the journey so far, and I hope you do.
Freddie Lim, folks. In case any of you are wondering, he's had a really long corporate career. Some of you might choose that route. Go and ask him at lunch how much an MD at Nomura makes. Okay, it's insane. The bonus that he gave up was quite a big deal. Okay, for him to go out there and start his own business. And you ask him, like, why did you walk away from that? Okay, you can have lunch with these guys. It's amazing. This is an amazing once in a lifetime opportunity, okay? I cannot stress how ridiculously good this is. So thanks very much to MAS and MoneySense for organizing this. This is why we're asking you to scan all these things. So I must give quick plug, huh? You see all this like social media stuff. Really, okay, so MoneySense is a government thing. They teach you to invest your money sensibly. All right, none of this, make 100% in 2 weeks nonsense. Speaking of which, investing sensibly. This is why we're here today, building an affordable portfolio starting out. I'm going to start with Francis here. So Francis, give us the basics. What do we need to know about investing at the start? Should we talk about asset allocation, diversification, compounding? Where do you want to start? Where would be a good place to start talking about how to start building a portfolio?
There can be a couple of hours of lecture on that, man. So
You've got 2 minutes.
Whatever Edward just mentioned, I think those are important. Just a quick show of hands, how many are finance or economics majors over here? I suppose those who didn't raise your hands, they are majors from others. But it's okay, because in the world right now that we're living in, unlike when I first started out, there's a lot of information out there. You even have it in the form of apps in your phone right now. At the start, of course, you find out a lot from your friends about what they're doing, join investment clubs, which I suppose some of you here are as well in your university. During my time, I think there was an investment club. I'm just not very actively in the investment club. So rather than giving you the fish right now, I'm teaching you how to fish. Join blogs, look at robo-investing, things like that, sign up for his regular weekly or commentaries, monthly commentaries, and right, so all these will be helping you. Compound interest, all these things are possible to find. One of the websites that I personally like a lot, especially, I left school many years ago, that helps me remember the basics of investing. I'm not trying to advertise for that particular website. It's called Investopedia. Investopedia. You get a lot of great information from there. Even as a professional today, sometimes I forget all my option theories and things like that. Oh dear, what's contango, huh? So things like that. I will go back to Investopedia. You can almost find any financial stuff over there. So that's a great place. So I'm teaching you how to fish, not advertising greatly for this website, but it's a great website to start out with, right? That's 2 minutes there only.
Okay, so later on, if you have any specific questions, literally asset allocation, very important. Diversification, also very important. Compound interest, lagi more important. Don't understand any of these things, ask later. We'll leave more time for Q&A. Okay, Chris, we're going to come to you.
Yeah, but can I add on a bit?
Yes, absolutely.
Okay, because I thought this question is pretty interesting. Because I've shared that, my children, they are probably about your age. So when my son actually graduated from NTU in accountancy. He studied finance, but he doesn't really understand investing. So when he came to me and he asked me, Dad, I want to start investing, what is the first thing that I should do? And actually I gave him that advice, and maybe this would be helpful. I told him first to really understand the instrument before you even put your money in, and start with something really simple. And some of the simple things that maybe you already know, but if you do not know, will be things such as Singapore savings bonds, will be things such as Singapore government securities, and now the very popular T-bills, because the yields are so high, right? Start with these things first, right? Because once you understand these things and you put a bit of money, now in investing, it cannot be academic. You cannot just study and learn about it without putting your money inside. Because you don't put in money, you don't learn, right? So you put into something like that that's so simple, right? And you start to see a bit of interest, a bit of the yields, then it gets you a bit interested. That was what he did, right? And then the next thing I introduced him was in exchange-traded funds, ETFs, because it's not difficult to understand ETFs, right? And when you buy an ETF, you are globally diversified. You can buy an S&P 500 ETF. You can buy a ETF that tracks the MSCI World Index or All Country World Index. So that was what he did. And that was how he really started. And of course, now he's getting more interested into other things, and it's been many years. But he's now more interested in individual stocks. He's now more interested in things such as crypto, and things like that. Now, I'm not saying that is the correct instrument, but well, it's always good to understand what it is, right? So that's something that I would suggest all of us to do. Take it step by step. Start with something simple, not so dangerous. Put a bit of money, get a bit of returns, then do something a bit more complex. Yeah.
Okay, this is a judgment-free space, okay? If you don't understand what the SSBs are, T-bills, lending money to the government, okay, that's basically it. ETFs, you don't understand what it is, you want to find out more, really ask us. Okay, or Google it, which is obviously the better option, but ask us later. We're happy to talk to you about it. I mean, since we're on this subject, Freddie, when you first started investing, how did you get started? What was your first investment?
I'm a bit of a weird case. I go crazy about markets at the age of 11. I think in 1992, when George Soros broke the Bank of England. So my motivation was wrong because he's my hero. It's like, wow, you broke a century. Wow, I was like, how can someone be attributed to this? So my reason was not from investing. It's more for the fun and thrill. But over the years, I realized investment for professionals don't really know investments. They thought they knew. They were arrogant about it, but we don't. There's a lot of stuff that we pay tuition fees with to finally get here. And today is very simple. Things that has been said. Before you invest, have a financial plan. How much can you make? How much can you spend? Do you have net savings every month? Let's start with that. Money you don't need, put it away. That is. And what is investing? My 11-year-old, 2 years ago, she's 11 years old. She asked me, Daddy, what's investing? That's what you do, right? I told her, because the school had a plant a tree program to save the environment. So what I told her was, investing is like planting a seed in the ground, and you water it for a very long time. And you watch it grow. Sometimes you have to prune it, you have to take care of it, you make some fine-tuning, but you had a goal that this guy right here is going to grow. He's going to have a certain, canopy, and that's your goal. But it requires a lot of time. And time means compounding. The power of compounding, according to Albert Einstein, not any investor, but a physicist, the power of compounding is this. If you understand it, you earn it. You don't understand it, you pay it. So when you're using wrong financial advisors, you're paying high fees, that's negative compounding. It gets worse and worse and worse over time. Not better. You have return, you have good financial plan, you stay in it, you reinvest, you stay with it. That return is positive compounding. So it goes both ways. I'll stop here, but to me, really, investing is a lot simpler. It should be simple, but it's patience testing. It's all about time. It's a marathon.
Thank you very much for that, Freddie. So you notice there's a trend now. We're telling you to be patient, okay? So a lot of you, because you're young, we know that some of you are in investing clubs. You have all these friends who tell you, wow, I tell you, last week I did this, then this week I made how much? 10K, become 20K already, become 50K next week. Okay, yeah, they're telling you all these things now, but that number might well be minus 2,000 in a month's time. Okay, when you take on, the risk you take on to get these kind of returns is sometimes completely ridiculous. But let's take a step back now. Before we talk about investing, we want to ask Chris, should we insure first? What is insurance? Why do we need to protect ourselves before we even think of investing our money? You share that with us.
Yeah. So insurance is really a risk management tool. Yeah, because you have a plan from where you are today and you want to go to where you want to be. But there are a few things that can cause your plan to fail. Loss of income due to death, loss of income due to disability, loss of income due to a medical condition. Any of these three things happen, that's going to disrupt your plan because you don't have any income. That may disrupt your family plan, right? And of course, there's one more thing that can cause your plan to fail. Increased medical expenses can cause your plan to fail, right? And maybe one last thing, right, which is losing your job. But losing your job is not a big problem because surely you can find it. Maybe it takes a bit longer depending on what you do, but you can find a job to replace that income. But those few things that I mentioned, they are big things, and if you lose your income, you may lose it for a long time. Now, so should you insure yourself? So you've got to ask yourself this question. Today, if you die, will anyone miss you financially? I'm sure many people will miss you emotionally, but not many people will miss you financially because your parents are probably richer than you. They don't really depend on you for an income. You get what I'm trying to say? At this age, your need for insurance is very low. There is no real need for death protection, generally speaking. I'll say general because not all of us are the same. Some of you, maybe if you are no longer around, maybe you really need to leave behind a lump sum for your parents or grandparents. That's an outlier. But generally speaking, you don't have dependents If death occurs today, nobody is going to miss you financially. If you are disabled, yes, maybe you have to replace your income to take care of yourself. If you are medically ill, critical illness, cancer, heart attack, kidney, you lose your income, you cannot work for a prolonged period of time. Maybe you need to replace that income for a period of time. But I would say at this age, the most important insurance for all of you to buy, and you must have it, is a good hospitalization plan. All of us, we have MediShield Life. Every one of us. If you are Singaporean or PR, you have MediShield Life. That allows you to stay in the B2 and C ward government. But if you want the option of a better medical care, such as B1 and above, and the option for private hospital, you need to have the option of private hospital. So you ask yourself, what options do you want? But what I'm saying is that the most important insurance you need to have is a hospitalization plan. The rest of it, you think about it yourself and ask yourself whether you need it. I'm not sure whether Edward is going to ask me this question later. I might as well say it now, right? In most cases, you only need a very low-cost term insurance. You don't need a very expensive whole life insurance in most situations, right? And for all those guys out there who have served national service, and I'm quite sure most of us have served national service, the best, cheapest group term plan to buy is the MINDEF MHA group term plan. It's the cheapest. You don't have to pay commissions to anyone, okay? And it covers you up to 1 million for you get it done. Even if you don't need it, you just buy. I just asked my son to buy it. And you are set for at least a good few years until you get married, have children, your liabilities go up. Then you review your insurance again, right? Edward?
Thanks very much, Chris. That particular NS SAF Aviva term plan is legendary amongst insurance agents. Legendary. Every time they say, cannot compare, what I'm selling cannot compare with that. Okay, always, without fail. Okay, you're not sure what it is, you want to find out more? First you Google, then you ask, okay? And we're going to move on to Freddie now, because there's this thing you mentioned earlier about watering. And so when you think about investing, right, a lot of people think, okay, that means I got to go stare at the charts all the time. I got to look at numbers all the time. Is that always the case? Or can it be a bit more passive? Can I just take a step back and then get on with my life and then let these things handle themselves, my investments?
Well, the answer is both. Let's say if I'm you today, if I know relatively less, then you have to invest in a diversified manner. And there's a lot of tools now. I mean, there's robo-investing platforms that I would promote as well, but there's also exchange-traded funds. They are super diversified. They have a great geographical focus. They're very broad. If you don't know what you're doing, it doesn't mean you shouldn't invest. You should do it in a diversified manner. But as you progress in society and work experiences, you may start having opinions. You may have been making some research, and you may want to start putting some money to it. That's okay as well. Everything is just about a certain allocation. I've been studying Tesla. I want to put 2% in it or 5% of my wealth in it. That's fine. But the other part should be diversified. So you can go hand in hand.
Thanks very much for that, Freddie. Okay. Last question for all three of our panelists before we go on to your questions is, I'd like you to share, starting with Francis, then Chris, and then Freddie, your biggest mistake that you made in investing so far in your life. Okay. Yeah, and the lessons you learned from that.
Right. The biggest mistake I make in investing, in financial investment, let's not talk about health or other type of investments, is that, first of all, I got started a bit too late. Remember I said that in the first part of my career, I was doing all sorts of things. That didn't really give me a lot of money to stay invested. But during that time, even I knew about ETFs and all these things, and robo-investing wasn't around yet, but I didn't really have the chance because I was fully concentrating in my work, of course, forgot to leave aside the 10%. So remember, start early. Once you step into the workforce, once you get a first pay package, make sure you're disciplined about it, setting aside 10, 20% into investment. Don't just every day go happy. Yeah? So that's the first thing. But that said, because I'm a busy professional looking after the portfolios of my clients, a lot of times I don't really have the time to look at my own portfolio. So quite a big part of my portfolio is now in robo-investing as well, in robo-advisors, as well as in ETF. So I look at technical charts for my client's portfolio, but I just simply don't have time to look for it for myself. So, well, I would say that yes, although I start a little bit late, but then again, there are a lot of tools out there that can help you.
Thanks very much for that, Francis. At this point, I'd like to interject and remind all of you, can take notes one. Maybe a good idea. I don't know, up to you, okay? All right, we move on to Chris. Biggest mistake in investing, what do you learn from it?
So my biggest mistake is listening to friends without doing any due diligence and any analysis on my own. When I was 26 years old, I bought a country club. It cost me about 27,000. It was called Fairway Country Club. I stay in the east, and this country club is in Jurong. I don't go there at all. But what makes it worse was that unknown to me that the lease remaining for this country club was like left 5 years. So everybody was just telling me, go and buy a country club. And back in those days, it was that belief that you buy a country club, you definitely make money subsequently when you sell it. Yeah, but then when the lease ran out, the government didn't renew the lease for the land lease for the country club. I lost every single dollar, right? And then in the 90s, it was the IPO craze in Singapore. Yeah, back in the 90s, it was called the roaring 90s in the stock market. And in Singapore, you don't have to think about what company you are buying. As long as IPO, just buy. That was what I was told. Right? So you go to the ATM, it's not about how much you put in, it's how much you can get. So whatever money you have, go and ballot for it, whack it, and then maybe you try and buy 10. But people believe that stock was used for punting. Yeah, just get it and then sell it. And so I did. So I bought STIC, I bought Golden Agri, and all that, without knowing even what I was buying. I just bought it. Those stocks I've never seen daylight. Yeah, so don't just listen to your friends. I think Edward said that. A lot of times people tell you all their winnings. They don't tell you they lose money. They don't tell you how stupid they are, right? And I think we are here to tell you how stupid we were. We're just listening to friends and buying things blindly. Most likely you'll lose money.
Thanks very much for that, Chris. So Francis says start early. Chris says don't anyhow listen to your friends. Very good pieces of advice. Freddie?
I think, okay, I was thinking, I have a lot of investments that lost money before, but the one that and a lot also made, but the one that I'm most regretting are the money winners. I didn't stick to an investment thesis that's very long term. And for example, I was, before founding StashAway, I was looking at NVIDIA and the chip making industries and the semiconductors industries, and I had a thesis that, more and more digitization, more computing power is needed. Actually, the ecosystem of blockchains are being built, and they even need even more computational power. So maybe a safer, a better way to be invested in this theme of digitization and the development of the blockchain ecosystems is to buy NVIDIA. I bought it at $12, and I sold way too early at 120. It has got, that was 2019 when I got it out, and it went as high as 342. So my problem was a trading mentality at the time, trying to take profits. But I should have asked myself, have my investment thesis been materialized? Is my scenario that's very long term, has it fully been met? And hence, there's no further potential to stay with it, right? So I still feel like a sucker punch today because this particular mistakes is exactly what I shouldn't do because, robo-investing platforms, we are designing it for the long term. Our philosophy is about economic trends, about economic potentials that needed a lot of time and compounding to happen. And yet, I had a trading mentality on this one, not trusting the thesis enough, right? So I think the biggest mistake is not trusting that well-researched thesis that you have done for yourself and actually taking yourself out of something way too early.
Yeah, so trust your thesis if you've researched it. Unless that thesis is invalidated, of course. Things change so that your thesis no longer is true. Otherwise, stick with it. Thanks very much for that advice. Freddie might be happy to know also. I also saw NVIDIA about 120, 2 days ago. Okay, so question answers. Any of you with questions? Go ahead, raise your hands, and we'll bring the mic to you. First, yes. I'll just come directly to you.
Hi, I'm Adrian. Since nobody asked a question, I guess I'll start first. Okay, so I'll just get a flow of rolling. So my question is more about, as students, okay, just maybe university like year one or back in poly days, where we don't really have much investment knowledge. So we all know that choosing a stock is mostly based on, I won't say mostly lah, but some of them will be based on the fundamental or the technical analysis side. So based on today's current outlook, which of those theories you should actually focus more in? Should we focus more on the fundamental side of the company, or should we actually look at the technical side of the economics? Yeah.
Francis, FA or TA?
I would say all of them. so back when I was in Philip Capital, I followed a great boss. He was a veteran from UOB. He came up with this thing called FVT. So first of all, you need to do a fundamental research. And I'm going to give an analogy. Suppose you go to the supermarket today, your mom asks you to buy apples. And then you go in and wow, so many different types of apple, Royal Gala and all these things. Right? So the fundamental is what do you like, what is great fundamentally. The apple must be really tasty. And Royal Gala, I'm not advertising again. Royal Gala is always very sweet, very nice. You can't really go wrong with that. The second part is V. So fundamentals is there. Do want all your research, right? Second part is V, valuation. Is Royal Gala today cheap? Or is there any other options? So your peer valuation. Is it better or not? If not, then you can wait. Don't eat apples today, eat pears. The last one will be T, technicals. You look at technical charts. So how I approach a stock, or even in the ETF, ETF you don't really need, just buy. Look at the stock is that, first of all, make sure fundamentally they are okay. They are not the codex of today. They are not the codex of tomorrow. So fundamental, great company, great management. Valuation, how cheap are they today? And guess what? Right now, in the listed space, they are pretty cheap. A lot of them, right? So take F, take V. The last part is when to buy. So what to buy? Is it cheap right now? And when to buy? When to buy, use technicals. I'll do a lot of technicals on my Bloomberg, and all your simple moving average, your MACD, all this actually works very well. You don't need a lot of complicated stuff. Last count, there's over 1,000 over different technical analysis tools. So don't need do those. A lot of traders look at MACD, right? You're a trader, so and the other thing. So the last part is when to buy. Are there technical signs that you will go a bit lower, then be a cheapskate, wait for a while longer. So I use all F, B, and T.
Can I just sort of frame what you said, because it's the same topic anyway. I feel like the fundamentals is the highway that you need to drive over with. Your technicals is sort of the fine-tuning, right? Your gear shift. It's like you're young, come on. You're just building your portfolio. It's not like you already had $1 billion to risk today. So you're building a port. You got to think about that too. Every month I'm buying in. When markets are down, the same number of dollars is getting more units of the underlying investments. When market is up, it's actually not as good for me, right? But as you get older, like myself, you start having more lump sums, and you're more at risk, you're more sensitive, and you're heading towards your retirement age. Your time to your goals is shortening, and you need to start adjusting risk lower. So, but for all of you in the room, wow, that's a fantastic time.
Long highway, yeah.
I'm not telling you to take risks to the maximum, but what I'm just saying is you got time to recover, and you also need time to build your portfolios. So what if it's a bad investment? So try something. You may not need to do technicals like us or fundamentals like us. Just invest in a very diversified manner, build it up. But if you do make the effort, do, like Chris said, put money to test your own self. Then it really relates to yourself, and you get even more passionate about managing your finances, right? I think that's the most important journey you need to do. So by all means, do FVT. I think it's greatly framed. But if you don't do it, it's fine. You need an investment plan, yeah.
So
Have a plan.
I'm going to just share with those people who are not finance students, because a lot of these things that we are sharing here may sound very technical to you. Now, when we talk about fundamental analysis, generally, we are trying to find out whether the stock that is right now trading in the market is expensive or cheap, right? And so what we do in fundamental analysis is to look at the future earnings of the company and discount it back. You need to discount it back because a lot of these earnings are forecasted. They are in the future. You need to bring it to today's value, so you need to discount it back, right? Now then you compare that price that you have gotten and compare to what it is trading right now in the market. And you decide whether it is cheap or expensive. In technical analysis, you are looking at a trend, right? And based on the trend in history and what you think would be, where do you think the market is going? Now, I just want to say this. Now, whether you are doing fundamental analysis or you are doing technical analysis, there is a forecasting nature involved because the earnings that is coming in the future is forecasted. Nobody knows what's going to happen to the company earning the next 5 to 10 years. So there's some forecasting involved. The same goes to technical analysis. Now, if you get it right, you get a return that is better from just buying the index. Does it make sense? Because when you buy the index, you're not guessing. You are just taking the price, right? But when you are doing fundamental analysis and technical analysis, you hope that you are right so that you get better than what the market is giving. That's called alpha. We use this term called alpha, but it just means better returns than the market, right? So I'm seeing some of us nodding because I know when I was studying finance, I didn't even understand all these things. Now, point is this. As an individual investor, it is not easy to do these things. You don't have the tools. Yes, you can attend AGM. The CEO can tell you his forecasted earnings. And I'll tell you that as a CEO, we are always very bullish. We will never go to an AGM and tell you that we're going to do shit. We'll be sacked. We'll tell you how good the company is going to do and the future earnings. It's up to you to believe him. And how do you know what he's saying is true? So as an individual investor, it's very difficult. Now, if you don't want to do this yourself, some of us don't have an interest, but you still want to do better than market returns, you can put your money with the fund managers or you can put money with the robo-advisors that does this and leave it to them to do it for you. Of course, you trust them to do it for you. You have to do a bit of research to make sure that these guys, they have a good track record. But I offer you a simpler way of doing this. You don't even have to do fundamental analysis. You don't even have to do technical analysis. If you are not greedy, you accept just market returns, right? Market returns means 50% of you make this decision, the other 50% of you make this sell decision, and then at the end, that is the price, right? And you're happy with that. Well, then you just, like what Francis has said, right? ETFs, you just buy the ETF, and that's market. If you buy the S&P 500, that's market. If you buy an ETF that tracks the world index, that's just market. But you are not going to get better than everyone else. You just get the average return if you are happy with that. Okay, so I hope that gives you an understanding because sometimes we go, I have this many dinner conversation with my son and he asked me about, fundamental, technical and all that. And then, okay, I can speak to you very patiently because you are not my children, but with my son, I'll say, forget it, just go and buy this. Because you will not have enough data to do all this. You won't have the Bloombergs and all that to get all this data. Okay, so I hope that helps, especially for those of us who don't study finance.
Bloomberg Terminal 1 month subscription, how much, Francis?
I don't know if my boss paying for it.
I pay $2,660 USD a month.
Yeah, that's right.
USD very expensive now.
And this is one of the many things I subscribe
For those
to.
two screens, 2,660 per month USD.
Not advertising.
How many terminals do you have?
I can have multiple.
Okay. That's probably cheaper because he has multiple.
Got bulk discount.
Because I have one terminal in the office and it's more expensive.
Wow. Sorry, I got a better deal.
So it's around 3K a month USD, okay? And you want to beat these guys? You want to beat the billions of dollars that have gone into algos, quant desks around the world? Yeah, Freddie can tell you all about the quant desks and how much money is being poured in. The top minds in the world. And with computers that move at speeds, with connections that will just blind you. 95% of day traders lose money for good reason. Okay? Look, let's say you're 25. You're not going to beat the market.
Do you want to have the best investment advisor in your team? Do you all want to? Do you all want to have the best investment advisor to help you investment decision? Actually, that's the market. Because you have one set competing with the other set, right? And the end result of the market price is what these two set of people are fighting.
Reversion to mean.
Right? But of course, if you want better, then...
Sorry, I do have one last line to say.
Oh, sorry.
We all have to put money to invest, right? So there's a return on investment. But if you invest in your own career and you're getting paid to do your job, but let's say you don't pay anything to invest in yourself, it's zero. Any return you make is divided by zero. That's an infinite amount of return. You should really focus on bettering yourself, your career direction. The highest ROI in the world is not in investments. So.
Words of wisdom. Thank you very much, Freddie. If any of you are hardcore about valuation, Aswaf Damadran, the Dean of Valuation, has a free course online. It's a university level course. It's available on YouTube, guys. ASWATH. Okay, you Google him. Free. Okay, free of charge. Next question, please. Yes.
Good afternoon. I would like to ask about asset allocation.
Francis, so any specific thing about asset allocation?
For beginners in investing.
Okay, introduction to asset allocation.
I think Freddie will have some
Freddie?
as well.
Just throw me to the roof.
Yeah. Yeah, we can add on. Yeah.
Start with risk level. You got to meditate about it. So I'm a quant telling you to meditate about it. So for example, whatever the amount you have, if tomorrow market crashes, what percentage will take to? If you get kanchong, nervous at 10, 20, 30, 40, 50, first you got to understand yourself. And once you fix that, and you already assume the worst can happen and you won't detract from your investment plans, that's the number for you. Then you work backward. If you're a higher risk person, risk-loving person, and you're young, that's completely fine. 100% equity. Buy a Vanguard total stock ETF that buy the entire world, go all the way. Fine, you got 30 years, 40 years. But if you're a bit more kanchong and you want 10% risk only, well, you need some bonds, you need some other stuff, right? Some Singapore savings bonds, you want to get some income, and you're thinking like older folks like me, then yeah, by all means. First, understand yourself, and that's your risk level. Just start with that.
Francis, you want to add a bit on, Chris, you want to add a bit on portfolio allocation also?
Yeah. So I'm just going to share 3 factors that affect your asset allocation. The first is your need to take risks. Your need to take risks is determined by your need for returns. If you are only happy to beat fixed deposit, there is no need to take risks. If you want to get 6-7% per year return, then you need to take stock market risks. Second is your ability to take risks. Your ability to take risks is determined by many things. Chief of it all, your time horizon. If you're only putting this money 6 months to a year and you need the money, some of you, you have a girlfriend or a boyfriend, you're going to get married in the next 2 to 3 years, your ability to take risks is pretty low because your time horizon is short. But if it's some money that you set aside and you have no use for it and you meant it for your retirement, I know it's too early to talk about retirement for you, right? But, well, you're thinking of setting aside money for, maybe I should use it, financial independence, retire early, FIRE, and you plan to do that 10 years, your ability to take risks is pretty high. There are other things that determine your ability to take risks, whether you are comprehensively insured. If you are not comprehensively insured, your ability to take risks drop, right? There are other things. How about whether you are married or whether you are single? When you are single, your ability to take risks goes up. But when you are married and you have children, your ability to take risks drops. So all these things. Last but not least is your willingness to take risks. Your willingness to take risks is the most abstract because your need to take risks and your ability to take risks is very concrete. Need, you can measure. If you want 6%, 7% return, you have to take some stock market risks, right? Ability, very concrete, right? I've got 5 years, then I cannot take too much stock market risk. If I've got 10, 15 years to go, like what Freddie has alluded to, you're not even 30, man. They are 20-something years old. They have plenty of time. Your ability to take risk is so high, you can be 100% in equities. However, your willingness to take risks, a lot of it is affected by your relationship with money. You look at how your parents manage money. You don't like the fluctuations of the market. Every time you think of the stock market, you think of it as gambling. So your willingness might not be there. Now, to determine how much to put into stocks and bonds, these 3 factors interplay. Okay? Let me just give you one example and I should end. Let's say you have a high need to take risks. And you can take risks, but you don't want to. Should you? You can, but you don't want. Should you? You need to study to pass exam. you can study to pass exam. But you go back home and you say, I got no feel. I don't feel like studying exam. Should you? Well, you can say you should. You should study. Great. Right? But you say, I just follow my heart and I don't study. You have to be prepared for the consequences, which is to fail. It's in the same way, investment is like that. You need to take risks. You can take risks, but you are unwilling to take the risk. Okay, it's fine. You just go and buy the Singapore savings bond, but the consequence is that you should accept a much lower return. Okay? You don't need to take risks. You cannot take risks, but you want. Should you? You don't need to take drugs. You cannot take drugs, but you got feel to take drugs. Should you? Answer is no. Now, so think about it, right? If you don't need that high return, and you cannot take that high return, but you feel like everybody, all your friends are buying, they blindly invest in FTs and all that. I'm not saying that's a bad investment. I'm just saying that very high risk, right? Then you should think about it. You don't need, you cannot, but you just feel like doing it. Perhaps you should not. Now, the higher the risk appetite that you have, you need, you can, very willing, the more into equities. The purpose of the bonds is to put in there to moderate the up and down so it's not scary and you can stay invested for the long term. That's a good purpose of the bond. But if you are young, you have the ability and you can really take the fluctuation of the markets, why put a bond in there to mute the returns? Right? The bond there is to just make sure that it doesn't fluctuate so badly that you can stay invested long enough for you to reap the returns. So just remember these three factors. I hope in some ways it helps you shape how much percentage of equities and bonds you should put into your so-called asset allocation.
And my final advice for asset allocation, thanks to the two panelists, is that it's important to hire a very good FA, financial advisor.
Actually, very quickly, because and great point there about not FOMOing. Don't FOMO, okay? FOMO is bad. FOMO really bad, especially for investing. Going partying, FOMO already bad enough, okay? Investing FOMO is the worst. Confirm you get it at the wrong point one. Okay, don't even think about it. But Francis, I need to ask you about this because some of you will be wondering, why we talk about stocks and bonds? Because there used to be this classic allocation of stocks and bonds, 60-40. All right, long time ago, okay, people will tell you, you didn't think about it, 60% stocks, 40% bonds, settled, your portfolio is settled. Francis, can you tell us a bit about, is that still a good idea today?
Well, it's a very classic thing about is 60-40 date. I mean, once in a while, a couple of months, you have in your BT or ST talking about 60-40, 60-40. But I would want to say that life is a lot more, not so simple as in 60-40. Right? There's a lot, you are in a world of a lot more things right now. I mean, just before this seminar even started, I was talking to Freddie about tokenization of illiquid assets. So in the world of private banking right now, we are even not just looking at stocks or the listed space, we are looking a lot into the alternative space. And private equity, venture capital, the ability to get deals, illiquid markets, things like that. So all these are the whole world of investing, but I don't, of course, suggest you get into it. Of course, tokenization is the ability to democratize public's access to illiquid assets. That's fantastic. That will be a new development that I believe today, all those coming here, which is a success, I will pat you on your back already because you are self-selected, you are interested to learn more. I believe today a lot of you will be involved some form or another as investors or even as business owners in future in the tokenization part. So 60-40, a bit too simple, but I think there's a lot more tools and choices into it. Personally, I'm involved in some PE myself. I'm involved even in VC, venture capital. So I think that not just 60-40, it can be 20-20, 20-20 or whatever. That will be a more wholesome way to look at investing.
Thanks for that, Francis. And remember, folks, if an investment is not regulated, you take on the risk.
Oh, yeah, that's right.
Okay, regulators reduce risk. Next question. Okay, I'll get the gentleman over there because
now all warm up already.
From the other side. Okay, then for the other two of you, I'll get to your questions after that. Go ahead, please.
Thanks for sharing. I just want to hear your thoughts about ESG investing.
Sorry, come again?
ESG, so
ESG
environmental,
investing.
social, and governance investing. So this is up and coming in the market already. There already. So basically, your thoughts about it. Should we get ourselves involved in like green bonds that companies are financing for it, or should we invest into sustainable companies?
Thanks for that question. SGX just launched ESG big initiative. Is it a fad, or is this here to stay? Freddie, let's start with you.
We started incorporating ESG as a extra dimensions to consider in the portfolios about 2 years ago. So we at the back end, we actually maintain a certain minimum scores, but we're also very careful to not overdo it because there's a lot of greenwashing. So a lot of fund managers in trouble now because they slap something that says ESG, end up you have a weapon maker name in there and all, right? There's all sorts of things are happening. The reality is on the ground, in the factory, if do we have something to monitor who is throwing and managing the waste? All right? Unless you have free satellite imaging all over the world and without human privacies, we can monitor. So really, take it with a grain of salt. ESG is not just about environment, there's social, and then there's also the governance. Governance includes things like board diversity, women, men splits, and human rights and all these things. So there's a lot about ESG itself. I would consider the whole bucket as new factors of investing. So in the equity world, we have a lot of styles of investing. You've got the famous Warren Buffett, value investing. We've got trend followers. We've got people who like dividends. People who like things cheap. Or people who like things aggressive, the growth-oriented ones.
These are all called factors.
Styles of investing, right? ESG is actually a new stream. And it does have a protective component. Like if you're investing in emerging markets or China, a name with a better governance and accounting disclosure, they command a premium in the markets. Or when the market drop, they actually drop less than the other competitors. So it is protective in nature. In times like this, it does actually is useful for fund managers like us. So I consider it as a risk management tool while maintaining my ideology on the side. I do want, it's a personal decision. We want a sustainable world. But I'll stop here. It's just for you to share.
Yeah, so last year, my firm did a study into ESG, and what we found is that there is no conclusive, strong evidence to prove that when you do ESG investing, it is going to give you a higher expected return. That's one. Secondly, the problem with ESG is that there are too many rating agencies, and it's very unlike bonds, whereby you just have those few like Moody's, Fitch, S&P, and they are quite consistent in the rating of a company. But with ESG, there are like a few hundreds, and they can rate, say, a Chevron, and the result will come out very different. So it's going to be very difficult to say that a certain company is ESG positive for your portfolio. So we are still at a nascent stage, and what Freddie has said, it's very new. The third thing is that right now, we have a portfolio in a company, a few portfolios that has ESG investment, and another set of portfolios that do not have ESG investment. During this period, obviously the ones with ESG, they have not done as well, because there's no oil inside. Now, can you accept as an investor that you might not get better return and instead suffer maybe 1% difference for the sake of the better good of the world? So the way we look at it is that for ESG, at least for now, until things become clearer, is that if you want to invest in ESG, it is an expression of your values. Right? You're not going to suffer, you're not going to, you might not, I wouldn't say you are not going to, you might not lose money, but you may not get better returns, like what many managers may say they can. Yeah, but do you want to make this world a better place? It's an expression of that value, right? And even when you do so, because it's so new, and again, Freddie used this word, greenwashing, sometimes you may be investing in companies that say they are ESG compliant, but actually it's not really true. So it's a very new thing right now, and so I'm not very sure. Yeah, Francis?
Well, in the private banking world, clients are increasingly looking at that. My experience over the past couple of years, especially throughout COVID as well, is that although the main owners of the relationship sometimes don't really know more or care about it, but as a private bank, we do a lot of education in investment forums or over the last 2 years in webinars. I do find an increasing trend that their second generation, their children, are quite into it, particularly those in ASEAN. So yeah, I think going forward, the next couple of years will be quite a lot of interest in ESG-related type investments. And I think just the interest itself may be able to hopefully provide a little bit more returns because more funds are going into this space. Of course, there are regulations that we have seen over the past couple of years that it's good to be ESG approved and things like that. So I think that will be your trend that you'll be seeing once you step into your career, that things got to be in ESG. So ESG is not just for public companies, private companies are also looking into that. So this will be a very exciting space.
Thanks very much. We had 2 questions. Who's that?
Hello, my name is Francis.
Hey,
just want
hi.
to ask, hello, yes. What are your views on holding onto stocks that are currently not doing very well in the market? Would it be better to consider holding onto it or to sell it away and make a loss and subsequently reinvest the money into other instruments? Which one would be better, and what are the factors that I should consider or anyone should consider when making this decision?
That's a great question. You're holding the bag.
Okay, this is what I will start first. This is what a lot of my clients has been asking this whole year. So I got standard answers to that. First of all, fundamental research. Is it a good company? Second, how long are you willing to be invested in this stock? Third, how much allocation do you have in this stock that you are already? I mean, we in the private banking space, I remember when I first stepped in, is that there was always a good advice. Investments are not supposed to be exciting. If you want excitement, go take a roller coaster, right? So we all manage it in a portfolio basis. So in the portfolio, if you really adhere to a portfolio, given by the financial advisor or from the guys from the private bank, from my office, generally you shouldn't be too fearful because at the end of the day, you're so well diversified that your allocation or concentration into a particular counter or stock underlying or even in an ETF will not be so big to make you without sleep. I've met clients on one end of the spectrum, and in portfolio analysis, we want to see, we are advisory, we can advise clients, we can nag at them, but a lot of times, they just don't follow, they continue to do that, all right? So it really, really depends, a lot of levers, right? Okay?
Yeah, you don't want to be praying that Xi Jinping says the right thing next week at the meeting.
Yeah.
You know,
You don't want to
86% in China.
take a roller coaster if you want excitement.
It's a bit much. That's why diversification is so important. Sorry, Chris.
Yeah, so I'm just not going to repeat what Francis has said. I think he has said it very well. But I thought I'd give you an analogy to help you understand why it is okay to sell something that's not doing so well. So you have water in a pail that has got a hole, and that hole cannot be patched. And there's another pail beside you that is perfectly okay. It doesn't make sense to keep hoping that this pail of water will not go down further. Instead, you should transfer the water into a pail that will not leak. Does it make sense? You only take losses, and whether is it a stock or a unit trust, because a lot of investors is always thinking like, oh, it's not doing well, but I don't want to sell now. I'll wait for it to become better than I sell. Because I sell now, I will realize the loss. You only realize losses when you sell and you keep in cash. You don't realize losses when you sell and you change. Alternative, right? So it's like a pail with a hole and a pail without a hole. So don't be afraid to take that decision if you are, like what Francis have said, you are pretty clear that that stock, you don't have the confidence that there's going to be a future. Or you buy into a fund, you don't think that fund manager is going to do that job for you already. You are not taking losses if you sell out and you change to another manager or you change to another stock.
Opportunity cost, right?
Yeah. Okay.
Thanks for that. Freddie mentioned earlier also about investment thesis changing. Yeah, the investment thesis is very important. Is your investment thesis still intact? Right.
So maybe go back and remember the first reasons why you make the investment. Are those views or analysis or fundamentals now violated? The hole in the bucket cannot be patched anymore, like Chris said. Then it's a bad investment, never hold on. And find new investments, right? So
Peloton. Okay. So, if you're just very quickly, before we go on to the last question, Peloton now 869. You remember what's the high last year? 171. Okay, IPO price $29. Now $8.69. Think about it. Okay, all these like pandemic stocks. Last question. Either of you two gentlemen, fight it out. No, scissors, paper, stone.
Question.
Hi, good afternoon. I'm Aaron. Just like to ask, in terms of the journey towards financial independence, is it important to set a specific goal with a time horizon? And how do you guys come up with that specific goal of, I need to reach so much by what time?
If we answer this quickly, we can take the other question also. Yeah.
Wow. This is a very good question, but a very tough question. very tough. I do not know whether I can answer it very quickly, but I'll try. I will say that life doesn't begin in the future. Life begins today. Why do I say that? Because there are a group of people who believes in fire, and so they set a date and they want to retire very early, say at 35 or 40 years old, and they sacrifice everything today to make that possible. But there are things that you cannot do in the future that you have to do today, right?
Like having a child.
Like having a child, building memories with your kids when they are growing up, being filial and bring your parents for a holiday when they are still around. You can't leave it for the future. And therefore, you need to sit down, look at your income, and ask yourself, what are those things that I definitely must do today, and set aside money for that. And then whatever that is left behind, you invest for the future. And based on the amount that you can invest and based on the return that you estimate you are going to get, then you ask yourself when you can be financially independent, right? Now, however, things are fluid. No financial plan you plan today will be fixed for the rest of your life. Things will change. You're going to get married. Your salary is going to go up. Your worldview today is a student, and you think you're earning 4,000 or 5,000. That's good enough. But you may earn a lot more, and then suddenly your definition of what is financially independent and how much you want will change, right? So there are a lot of things to talk because there are a lot of moving parts. But I think I'll just stop here, sort of like conceptually to give you an idea of how you determine when you want to stop. Because if you sacrifice so much today, it may not be well worth it.
Thanks very much for that, Chris. Final question.
Testing. Hello. So I'm Aloysius from NTU, and thank you for sharing. So just want to check. So you know how when we do valuation on stocks, we look at like historical value and then the future value of it. But what if we are looking at like cryptos? So in this case, how will you do valuation for it? Yep.
Just very quickly, if it's not Ethereum, there's no basis for doing analysis. You can't compare it to other than ETH, and even then, that's very questionable.
Well, I mean, disclaimer first. Find out all the risk factors of it. You know, you have a cold wallet. It's a hardware failure. That's done, right? So there's a lot of other problems. But it's an evolving, disruptive technologies. The path to getting to success is very rocky, right? So let's get it out there first. But to answer your question, the equivalent of price earnings framework in crypto is not based on assets because they're not backed by anything, but they're backed by utility, our willingness to get in the network and transact among ourselves. There's a law called McAfee law. If you're interested, search for it. METCALFE is a Morse law equivalent of network effect. You can use that to evaluate companies like Facebook, Tencent, Amazon, anyone with a marketplace where people are transacting. There's value in the network based on how people are transacting. So definitely have a look at that just to be useful to you. And fund managers in the cryptocurrency space actually looks at price to McAfee law ratio. So it's like a PE ratio equivalent. So it's based on network. The network grows, the power, the value of network. If the number of people grows or number of people transact more, the value of network goes in a certain exponential manner. But by definition, that's also risky when another token start winning attention away from, I don't know, say Dogecoin was popular, then it's not popular, so you got this square up and square down effect. So it's by design volatile because of McAfee law. So definitely go read up to it. You seem to be interested in the technical, so go for it. Why is it volatile without even human animal spirit? Now you add on human animal spirit, it becomes really, really interesting and volatile. So just go for it.
Yeah, go do your PhD on it and give us the results, okay? Please.
And you can sit here next time.
Okay, so last thoughts.
Yeah, so when you asked that question, I was like, wow, because the answer is I don't know. I went for a 3-month program on cryptocurrency because I wanted to find out a bit more before I put some money into it. And they didn't teach anything about valuation at all. But I want to bring back the model to all of us to consider before you put your money into crypto. I have some money in crypto. My son has some money in crypto. but it's a very small amount because we felt that there was no need to take the risk. We do not have the ability to take the risk, putting that money into that crypto, and we were pretty unwilling. Right? So for the serious part of money, because the biggest problem with crypto right now is there is not enough evidence to show you that it's going to reliably give you the expected return. And because it's like that, I don't need to take the crypto risk. I cannot take the crypto risk by putting the bulk of my money inside. I'm 52. I've got 8 more years before I retire. I don't have that ability. And I'm very unwilling to take the volatility. My crypto portfolio is down 60%. I have Terra, 0. But it's a small amount, right? So I laugh over it because it's a really small amount. But because I'm unwilling, I have a very small proportion. So yeah, it's fine. I'm not going to tell you like it's a scam. I'm not going to tell you that. But please consider before you put your money, do you need to do it? Can you take the risk? How willing are you to lose everything? Because sometimes it's not just the crypto becoming zero. Freddie mentioned, right? Binance just got hacked. $100 million gone. You can keep in your hard wallet and you can lose it. Then you cry if you put the bulk of your money inside. So do consider that before you invest that money into crypto.
Francis, I'll let you have the final word.
Right, my general rule is that if you can't value something, it's not called investment, it's a speculation. So that's rule number 1. And I also, during the crypto craze, I even have guys overlaying technical charts on crypto. All sorts of funny things. And my next one is that, another with a friend is that he said, hey, do you put money in crypto, right? Things like that. I said, no. They said, okay, how much have you earned? He said, wow, I earned the whole sum. I earned $100 from it. I said, huh? Why? Because I'm so scared I put so little. Then I said, then might as well forget it. Things like those are analogies.
Thanks very much to our panelists. Thanks to every one of you who asked questions also. Don't worry, they will be around for lunch, so
because we're hungry.
And so I won't keep you all from lunch or so, but please give a big round of applause to our 3 panelists, Francis,
Thank you,
Chris,
everyone.
and Freddie. Thank you very much. Dan, over to
Thank
you.
you very much, and we invite you guys for a group photo. Yep. That's right. A very insightful advice and consideration. It's very important, and I love the analogies being given. Very interesting. All right. So we have all of them. Okay, please remain behind. We'll remove the table as we will also invite for a photo Mr. Kee Wei Xiong, Executive Director, Corporate Finance and Consumer Department, Monetary Authority of Singapore, Ms. Samantha Wong, CEO, Financial Planning Association of Singapore, as well as Angeline Teng, Manager, Head of Consumer Banking Project, the Association of Banks and Singapore, to join us, as well as all the partners, the organizing team, MoneySense. Everybody come down. We'll take a group photo. Join us, please. And guys, get ready. We'll have a group photo. Right, other partners, join us. Come on. Yes. Recording.